Hello and welcome to the DTP podcast, covering everything concerning social housing from finance to regulation. I'm Stewart, and in today's episode we're looking at how the latest political, economic and geopolitical uncertainty is affecting the social housing sector. Rising energy costs, persistent inflation and continued volatility in interest rates are creating further pressure on social housing providers' business plans. At the same time, providers are balancing increased investment in existing homes with development ambitions, regulatory requirements, and the need to maintain financial resilience. So what should boards and leadership teams be considering? How robust are current stress testing assumptions? And what does the changing economic environment mean for treasury management, borrowing, and future development? To explore these issues, I'm delighted to be joined by DTP senior consultants Mohammed Akhtar and Stewart Hulme. Mohammed and Stewart, welcome to the podcast.
Hello.
Hello.
Good to have you both. So, Stewart, let's start with you. How does the recent political and economic uncertainty impact on the social housing sector?
Yeah, so international geopolitical events in the last year have had an enormous impact on the global economy. The US and Israel war with Iran began back in January, February time, and that caused oil prices to spike over 25% when the Strait of Hormuz closed, and Iran targeted the oil infrastructure across the Middle East. Price fluctuations of such an important commodity naturally lead to inflationary pressures across many industries, including our social housing sector. We saw this impact when the Monetary Policy Committee cited volatility in global energy markets as a reason for maintaining the base rate at 3.75%. And to further compound economic uncertainty, we also have the prospect of renewed tariffs from the US on its trading partners. The announcement of Andy Burnham as our new Prime Minister and subsequent reinstatement of Angela Rayner brings its own uncertainty for the sector. Andy is reported as putting housing at the heart of his agenda, and this appears positive. However, details of how this will be delivered remains to be seen, and it'll likely take a long time. What we do know, though, is that economic uncertainty directly translates into a difficult financial situation for social housing providers.
So I guess, Stuart, what you're saying is we're certain of more uncertainty.
Absolutely, yeah.
Right, okay. Well, thanks for that summary. I think probably a lot of our listeners will be aware of that. We're all living through this. So I'm just going to take us on to Mohammed. So let's focus a bit more on the social housing sector, Mohammed. So, what are the main implications that providers should be considering?
So in recent years, we've seen several global and national events which have impacted the finances of social housing providers, from COVID-19 to Liz Truss's mini-budget. The economic uncertainty caused by the war is just the latest situation causing increased pressure on business plans. As Stewart mentioned, we've seen relatively high inflation rates. This has directly impacted areas such as repair services, with higher vehicle-related costs and material costs, but will also have other inflationary effects, as the Bank of England now predicts that inflation will not reduce to its target 2% until at least 2028. Before the war, forecasts were that inflation would be at target levels later this year.
So, Mohammed, what can the Bank of England actually do?
The Bank of England tackles inflation with increased interest rates. Whether this is the right approach when facing a supply-side shock is much debated. What we do know is that in the last year, the bank had started to decrease interest rates from a high of 5.25% down to 3.75%, and further decreases were expected throughout the course of this year. Since the war broke out, the Bank of England has held interest rates at 3.75%, and economists are now indicating that there won't be any further reductions this year, with some predicting a rate increase could be on the cards. A rise in interest rates will directly impact borrowing costs. We've already seen SONIA rates increasing and gilts reaching their highest levels since the 1990s. Providers should be reviewing business plan assumptions to ensure the changing economic environment is adequately modelled and the impact of these changes on the plan and budgets are understood.
Thanks, Mohammed. So, Stuart, can I just bring you back in on this? So let's just look at development aspirations. What's going to be the impact for social housing providers?
Well, we've seen social housing providers that we work with already cutting back on their development aspirations as financial pressures felt over recent years take effect. There's conflict in demands on finite resources, including building safety compliance, climate emergency, further AWAB's law phases, and the 2026 Decent Home Standard, plus others. These leave very little room for development spending on top. And higher borrowing costs and growing inflation mean that business plans will continue to be put under pressure for longer. We're seeing tough decisions for boards already on what they wish to prioritise, and sometimes development just isn't the right fit. However, there is a clear expectation coming from the government that providers are expected to contribute by pushing targets for building new social homes.
So I guess from what both of you say, Mohammed and Stuart, there's no slack at all at the moment in anything. There's no leeway, is there? So which sort of brings us on to stress testing. Mohammed, what should providers be considering when stress testing their business plans?
The economic turbulence we have seen this year shows how quickly a worst case scenario can become a reality. It's really demonstrated the importance of understanding the impact of those worst case scenarios on business plans through stress testing and associated mitigation planning.
So, Mohammed, just taking that, if I'm a board member, this is obviously quite worrying. What should I be doing? And what should the boards be collectively doing?
Boards require assurance that the stress tests undertaken on their business plans are appropriate to the business, the operating environment, and the risks set out in the strategic risk register. The purpose of stress testing is to push the plan to its limits. Finance team and board should be asking, do we think that our stress tests truly reflect the worst case scenario, and do we have the right mitigations in place?
Okay, Mohammed, I'm just going to step in there and put you on the spot. So, what can they do next? Is nothing off the table?
So yeah, a pragmatic approach should be taken, and providers should be considering all avenues, even mergers if there's indications that their business is becoming financially unviable. Having a proactive approach to merger is always better than waiting until a provider is facing financial challenges. Boards should be considering their appetite to merger regularly and have in place agreed merger statements which include what they would or would not consider in any partner and under what circumstances merger discussions may be triggered.
Thanks, Mohammed. So just bringing you back in, Stuart, beyond business planning and stress testing, what else should social housing providers be doing to prepare for potentially turbulent times?
So, treasury risk management becomes increasingly paramount. Providers need to be identifying funding needs and ensuring there is sufficient liquidity in place. The regulator of social housing in England recommends a minimum of 18 months. However, we see associations regularly use 24-month policies. There's no stipulated timeframe that liquidity should cover in Scotland and Wales. However, the expectation is that there should be sufficient liquidity for providers to be financially viable. So interest rate risk also needs to be very closely managed. We've seen examples of providers with large volumes of variable rate debt getting hit hard by interest rate increases. And with interest rates so unpredictable, ensuring that your treasury policies are designed to mitigate this risk to a level consistent with your board's risk appetite is absolutely key. So if you have fixing instruments that are due to expire in the next couple of years, refixing the debt may need to be a priority. Those needing to go through a funding exercise will need to spend more time preparing, monitoring how funding needs change as business assumptions change, and being more thoughtful on the funding options that best suit the organisation. We recommend that you start engaging your treasury advisors well in advance of funding requirements so that they can support you in getting the best offers available in the current market.
Thanks, Stuart. So I think there's just a final question. Just going to bring you in for this, Mohammed. With interest rates so high, should providers be looking to fix debt, or is it better to hold these at a variable rate?
Now, there's no right answer to this question. The correct decision will differ from organisation to organisation. The important thing to remember is that the purpose of fixing debt isn't necessarily to lock in the lowest rate possible. It's to give certainty of future costs and cash flows and to protect the business against fluctuating interest rates. We've seen in recent months how volatile interest rates can be and how little control providers have over variable rates. Therefore, even in a high interest rate environment, it's still important to have a percentage of your debt at a fixed rate. Exactly how much of your debt should be fixed and for how long will vary based on your organisation and its treasury structure. Your treasury advisors will be able to help you and your board decide on what the right approach is for your organisation. And finally, DTP can provide support in all aspects of treasury and business planning. If you'd like to discuss any of the challenges we've talked about today, please get in touch.
Well, thank you very much, Mohammed and Stewart, for sharing your expertise and this snapshot of the very turbulent world we all live in and what it means for the social housing sector. And thank you to everyone for listening. As Mohammed said, if you'd like to discuss any of the issues raised in today's podcast, please get in touch with the DTP team. We'll continue to bring you the latest insights and developments from across the social housing sector. In the meantime, follow DTP on LinkedIn or visit our website for more podcasts, articles, and updates. Thanks for listening, and we'll see you next time.